Everybody. I'm glad to be joining you guys here at Timing Research. And my name is Doc Severson. I'm going to be talking about zero-day options trading strategies. So off we go. Quick legal disclaimer. I'm not going to walk through this. I'm not going to be talking about any live trades. Please treat your trading like it's your business and not like a hobby. Otherwise, it'll be the most expensive hobby that you can imagine. So some of you may have heard of me before. Some of you have not heard of me before. Who is Doc Severson? Who am I? I am a poster child for Rogaine, I'll tell you that. But I've been around for a while now. This is about 15 years that I've been an option coach, trading coach, and really a business coach as well for people trying to transition into the world of trading for a living. So the current services that I run right now is ReadySet.Trade, which is brand new. We've been around for about 3 months, as well as ReadySet Crypto. We've been going for about 2.5 years over there in the wild west of the crypto space. You may have heard me before through Options MD or maybe TheoTrade or Doc's Trading Tools, or once upon a time, I used to run a service called the Options Linebacker. And my specialties are fractal price analysis, which I just wrote about in my brand new book, which is available on Amazon, about fractal energy trading. If you have difficulties mastering multiple time frame scenarios or wondering why you would want to use multiple time frames, then this book is for you. As well as the book that I've got, which is called Hacking the Holy Grail. If you make decisions that you can't explain later on, if you have trouble with your trading mindset, then this is one book. I had to hack myself, right? I had to understand why I was making all those silly decisions first before I could become profitable. So this is why I do what I do, and that's who I am. So today, what are we going to talk about? Well, I'm all here for the little guy. It seems like we've lost a whole decade of retail investors. After 2008, there was a lot of people that just walked away from the market, period. And my sense is that a lot of the younger investors have really stayed away from it from a long period of time, and they're just now getting into it. And the problem is the same one that we've always seen. Today's small investor getting started without being taken advantage of or hurt from a lack of knowledge. I want to see the little guy win, and I hope this is not the first time that you guys have heard of Alexander Kearns, but this is just a crushing story that happened today, and it's because of the lack of knowledge. So I don't have any affiliations with anybody else's presenting today, but if I bring them up for any reason, you can be assured that they're undoubtedly cool and worthy of your time. So let's get started with today's presentation. Why are we here today? Everybody's trying to set themselves up for financial freedom. This is why we're all here. This is why we're taking time out of our schedules today to talk about this stuff. The problem is we keep using yesterday's methods, and it just kills me because I see all of yesterday's methods still being talked about in ads, in Facebook ads, on television commercials, and email campaigns. These people have billions of dollars of advertising out there, and they just continue to wash the same messages out there through the masses. And it's the same old thing. Now, you guys will recognize some of these, right? Grow the pile. The old paradigm of investing was to continue to build your assets for someday. You know, someday you're going to retire. What about today, though? Well, the problem with building your pile of assets for someday was then you're expected to be able to cash flow them through just regular old interest or very conservative types of investments. You know, you could, on $1 million, you could live off that at $50,000 a year at 5% APR. Good luck with that, right? Because the problem today is that interest rates are approaching 0%. I don't think I need to tell anybody about that today. There's just no yield out there at all. And this is because, of course, the helicopter money, or in this case, dropping it from an airplane. We all know why this is. I'm not here to complain about it. You can't trade the market that you want, only the one that's in front of you. So what are the other alternatives that we have right now? You've heard about things like annuities. Well, they lock you in for years to receive a tiny rate. Bond yields are still correlated to the interest rates, not paying much at all. Now, you can get into stock dividends, and I hear a lot of people talking about stock dividends these days as a replacement for interest rates. But the problem is that usually the yield is correlated to the performance. So in a case like this with a lousy stock, which has been in a multi-year downtrend, they're trying to offset the performance of that stock by giving you some ridiculous interest rate for your dividend. It's not worth the risk, guys. So most of the other performing stocks are either not paying dividends or have stopped paying dividends. Those are the current alternatives. So that means that most are not prepared for this new reality, as Private Hudson would tell us here. So you can follow the old paradigm of growing your pile of assets, but being able to make money on your money is just no longer there. So what's going to happen is all these retirees are going to be shredding through their principal, and they're going to run out faster than they can believe it. So what do we do? Well, let's go to the concept of income. Income to the rescue. Income is what we once received through these interest and dividends and bond yields. Now, these haven't changed at all. These concepts haven't changed. Passive income is basically making money while you sleep without really doing anything about it. So this is like interest or dividends or owning partially interest in a company, things like that. There's also active income. Probably the best example for that is just working a job, right? Work a job is active income. So this requires participation and effort to earn income. So this is either, you could be active trading is another way to create an income from that. So are there different forms of passive and active income that can work to replace those old vehicles? Well, fortunately, the answer is yes. But it's not going to be with stocks, guys. So after a 12-year run off the bottom, and even after the most historic crash, the biggest one in 91 years, stocks are still expensive due to this Fed policy. So the market is way up still. I mean, as of Wednesday, yesterday was up 367% from the lows. And so what they've done is they've created asset inflation. So if you want to buy the market leaders, you got to pay a fortune for these. And if you have a small account, you're going to sink your whole account into buying one or two shares of one of these monsters. And guess what? You've got opportunity costs. There's nothing else you can do. You sunk all your capital in just one or two plays, and you're not going to be able to create any kind of income trading in and out of these. And for those of you with small accounts, you know all too well the problem with the pattern day trader rule, PDT. So it's not really, if you're going to be day trading stocks, it's not really a viable alternative, especially those with small accounts less than 25,000. And trust me, these days, a $25,000 account is not that small anymore. That's considered to be a medium-sized account. It used to be a small account. Now it's bigger. There's a lot of people running around out there with small accounts looking for solutions for that. So trading stocks is not really where we want to be. It requires too much capital, too much trading, and pattern day trader rules are way too restrictive. If you've ever been locked down by the PDT rule, you know exactly what I'm talking about. It's like being thrown into jail. So stocks for income, no, it's not the right solution for today. So what we can do instead is, I'm sure you guys have heard this all day long today so far, options are the answer. Options allow us to replace our interest income from the old paradigm. So we can create passive income with them. We can sell longer term options to act like an insurance company. We're selling the risk premium to buyers, or we can play active income. We can look for short-term opportunities to either buy or sell options using the leverage of options to more efficiently use that capital. So here's my assumption for today. I know what assumption spells out, but let's save some time here. My assumption for today is that since this is an advanced options webinar, I'm not going to go into options 101. I'm not going to try to sell you guys on that you should be trading options. I'm going to assume that you guys are here because you want to learn some advanced strategies. So let's get right to the solution here. How do we generate income using 0 days to expiration options strategies? Let's get right into it. And I'm going to start by suggesting that we earn $100 a day in income. So how do we create this income? Now, first, before I get out this, I have to get past this sort of whole, mental resistance of $100 a day. Come on, seriously? When are you going to get real here? It doesn't sound like much of a goal. And in today's world, everybody is out there shouting and screaming about making 15,000 a day, 20,000 a day, things like that, getting people lit up. That's the problem, right? This is unrealistic, especially if you're new. So earning $100 a day is not particularly difficult, but think about if you do it day after day after day, right? If you can earn, or if you can improve something by 1% better every day, at the end of a year, you're going to be 37 times better at that. So whether that's performance or compounding, whatever you want to look at in terms of your own skills or money management, right? The power of tiny gains. This is called the aggregation of marginal gains, and it's an extremely powerful concept. Tiny gains add up. So I don't care where you start. I don't care if you start at $1 a day. If you can do it consistently, that will eventually lead to $10 a day. If you can do it consistently, and eventually $100 a day. And if you earn $100 a day, that will change your life. You can live on that. I don't care who you are. You can find a way to live on that and augment what you're doing. So let's pick one thing. Let's start with a modest goal, and let's continue to improve on it every day. Let's not be a jack of all trades and a master of none. Let's pick one thing. Let's get really damn good at it. This is how the professional is going to operate. Trading 0 days to expiration options allows us to get lots of trades and potential improvement over the span of a year. Okay? So let's talk about this, the income pyramid. We don't just do everything, all out. What we're looking for is with larger trades, we have more capital to put towards them. So generally like a non-directional index trade, so a larger swing trade, these could be cash secured puts that we've already talked about. These are the slower passive income trades. These are down here. So if I'm writing puts on something, these trades are in there for 6 to 8 weeks. And, maybe I'm earning something like $8 to $10 a day on these trades, just doing nothing, letting time value just burn away, right? You don't have to do anything with them. But if you don't have that capital, usually it takes a little bit more capital to drive these types of strategies. So for smaller accounts, what we're going to be looking at is more of these, right? Either directional or maybe to some degree non-directional option trades, or even futures trades using the new E-mini micros. So we use everything in a blended approach through what we call the income pyramid. Now your approach is going to be based on, and everybody's different with this. A lot of people come to me and say, hey, Doc, what should I be doing here? Well, it depends on your capital. It depends on how much time you have available, not only to learn, but also to trade. And it depends on your knowledge. So to me, everybody's going to have some combination of this Venn diagram here with capital, time, and knowledge. So the perfect combination would be right in here, but nobody's got that. So let me tell you what I would prefer to see. I will take somebody any day which has got a small amount of capital and maybe even a small amount of time, but invests in themselves and has a lot of knowledge. Knowledge is investing in yourself, and it doesn't go away. And this is impressed upon me a long time ago when I invested heavily. I can't believe what I paid once upon a time to learn about the markets, to learn about options, but it's been a great investment over time. So knowledge is something that does not go away. So give me any day, somebody with a small account, somebody with not a whole lot of time, maybe you're working a job, but willing to invest themselves in knowledge. This person will be successful. There is nothing that will stop this person. However, what I tend to see is kind of the opposite. I see a lot of people that have a lot of capital, and maybe they got all the time in the world to trade it, maybe too much time, and they have small amount of knowledge because they're in a hurry, right? They're in a bloody hurry to get going and they want performance right now, get rich quick right now. This combination of capital, time, and knowledge means that very soon they're going to have a smaller account, smaller array of capital. They probably won't have any more knowledge. In fact, now all of a sudden you're going to be trading from a position of fear instead of a position of strength. And they'll still have the time available, but they've traded capital with somebody else. They've funded somebody else's account is what they've done. So that is the most dangerous one to me. And everybody needs to figure out what type of combination you're going to be. But if I could just tell you one thing that you're going to stick with from here today, between time, capital, and knowledge, people overestimate the impact of capital. Knowledge is by far the most important weapon that you can have. Now, it is easier with larger accounts, sure. So like, for example, like we could sell this, we sold the Advanced Micro Devices put back here in the middle of May, sold on a pullback, which is what you always want to do on a put sale. And we've had to do absolutely nothing, and this thing is going to expire tomorrow. So we could earn that $100 a day or whatever our income goal is by just selling a pant load of puts every month. But you don't want to do that. Well, first of all, maybe you can't do that. Maybe you don't have the account size to be able to do that. And so this is just not going to work for you. Even if you did, though, I wouldn't want you to do this because eventually you're going to get run over. That freight train is going to run right over you here because you don't have a balanced portfolio. So too much time risk, way too much delta risk on this trade. So it appears to be easier with a larger account. Certainly is to create passive income, but that's not the entire picture here. So what we'll focus on today is active income with these 0 DTE trades. We're going to talk about active income, 0 days to expiration options. We're going to place these and remove them in the same day. And here's the key. If we can get around the PDT, the pattern day trader rules, if we do these 3 times a week. 3 times a week, we'll stay under the radar. We're not going to get tagged as a pattern day trader, and we're not going to have our account locked down into purgatory. So we're going to be flat at the end of the day, which is a really nice thing in today's market. If you haven't noticed, we're gapping all over the place every day. You don't know how any particular day is going to open up. With a big position, that might lose you some sleep. So that's the whole point here, is that we're okay saying that we can earn a small amount of income every day, right? It doesn't sound like much, but over time it adds up. Tiny gains will add up. That's the aggregation of marginal gains. So let's get into 0 DTE options. These are ones that expire today. Now, you guys have heard of weekly options for a long time. These are ones that are on Friday. There's Friday. Maybe this is Thursday. I'm not sure. Yeah, that's Thursday. But here's another Friday. These are all Friday options. Those are weeklies that have been around for a long time. But the S&P 500 has Monday, Wednesday, and Friday. And sometimes, like today, it's actually got a monthly option that expires today. Don't trade the AM settled, though. Never, ever hold those overnight. You guys know better than that. So you have more than this, right? So 3 times a week, these things will expire. So that's the SPX, and also the spiders are the same way. Monday, Wednesday, Friday. 3 times a week, you have an opportunity. Not saying you have to. There's days where you want to step aside and let the freight train run through. But Monday, Wednesday, and Friday, you have opportunities to trade these. Time decay is massive on these 0 DTE trades, right? And you guys know that it's exponential. The faster we get, or the closer that we get to this is like walking towards an open flame, holding an ice cube in your hands, which is already melting from the heat of your hands. But the closer you get to that flame, the faster that ice cube begins to melt. And so you see this right off the bat on Monday, Wednesday, Friday. You start to see these options, the fluff come right out of them right after the opening bell, and it just continues and gets faster and faster through the day. So all of that extrinsic time value premium evaporates by the closing bell. These are very sharp instruments, guys. If you're not an expert at the entry, defense, and risk management of your particular option strategy, do not learn on these, even though it's tempting because everybody wants to get rich quick. Learn on some slow trades first. There's a reason why the batting cages, you don't step into the 100-mile-an-hour batting cage first, right? You're going to blink and the thing's going to be past you. You start at the 40-mile-an-hour and you learn how to hit that pitch. And then you step into the 60-mile-an-hour. You learn how to hit that pitch. And then stepping into the 80-mile-an-hour is a whole quantum leap past that. Learning how to hit an 80-mile-an-hour fastball before you even can think about 100-mile-an-hour. Can't believe those things. With today's legal environment, I can't believe those businesses are still in business. There we go. So zero DTE options are very, very fine, sharp instruments. It's meant for catching edge. It's meant for people that know what they're doing in the space of a very short period of time, right? So these are the fast pitch of options. Options are the power tools of the financial world. And then beyond the financial world, these are the Japanese saws of the power tools, right? These are extremely sharp instruments, not to be messed with. This is not the way you learn on these things. But I'll show you what's going on today. Now, bonus points for anybody that can recognize the quote from Apocalypse Now for this visual. But let's talk about 0 days to expiration long options, first of all. So I'm going to go into rapid time decay here. So aren't these options about to expire? So think about that. If you're going to trade a long option, your first thought might be, well, why would I want to do that? These things are about to blow up on me. Yeah, right? The extrinsic or time value of the option is about to go to 0 by the closing bell. But there's some benefits to this. There's some benefits to going long options on here. And one of them is just how responsive it is. So for those of you that understand the Greeks, gamma, which is for those of you that sell options, you guys hate gamma because you just want nothing to do with it. And gamma is basically saying to the price of the underlying stock that you're trading, please stay the hell away from me, right? Stay away from my positions. So when we're short gamma, we don't like any kind of price movement. But when you're long options, gamma is what you want. Gamma is you want every bit you can. And that peaks on 0 DTE, peaks on the last day. The at the money gamma gets extremely high in expiry day, which means that an option's value literally will explode as it becomes at the money. So it makes that transition. This is where the deltas begin to really scream. So they're very responsive to, if you get the direction right, these can make you a very nice return in a very short period of time. But what you have to do is you have to find trend days for this. Don't trade these on normal range days because you will, like Ivan Drago, you will lose. And they are great though for trend days. Now, this is one of the skills that's been around forever in options, and people don't really realize how powerful this can be. But if you have a price, let's say the price is 314 right now on the spiders. What would that option be worth if there was a quick move up to 315? So that's a 10-point move on the underlying S&Ps. It's a 1-point move on the spiders. What would that option be worth if right now it's $1.09, right? Or let's just say it's 84 cents, right? That option here at 314 is 84 cents. What's it going to be worth if there's a 10-point move? Well, what we can do is we can simply count backwards and say, here's an option that used to be at the money and has gone in the money by 1 point and now is worth about $1.38. So that move from 84 to $1.38, which is 54-cent gain, 64% return on capital for a 10-point move on the underlying S&Ps, which is next to nothing these days. Okay, so this is how you can sort of estimate. This is an old school trick to estimate the value of a move. But these are difficult. This is difficult to get right. This is like Odysseus shooting his arrow through the axe handles. You have to get so many things right to win on these trades. You have to get the direction right. You have to get the velocity of the move right. You have to identify it as being a trend day to have a better chance of winning. The duration of the hold for you to stay in it. So these always look simple at the end of the day, like, oh, I would have, could have, should have taken a long option here. I would have made a lot of money. But they always show up when you least expect the trend day, right? Nobody expects the trend day. So instead, what I'm going to do is I'm going to highlight some strategies that are a little bit easier to win and give you a bit more confidence. So these are viable. These long options are viable, but they're tough to win. Don't let anybody kid you that these are easy. They're not. So we're going to start with, I'm sure you guys have never heard of this before, the Iron Condor. We can use the Iron Condor for these 0 days to expiration trades. However, I do have a few caveats and maybe a little bit different way of looking at these things. There are different types of Iron Condors. So not all Iron Condors are the same. So the higher probability trades, these are typically the ones where you see like people saying, okay, we're going to use a 0.9 delta on the puts and 0.9 delta on the calls. And if you multiply these two probabilities together, you get 0.81, which is the probability of success for basically a 10 delta. So these are 10 deltas, which is the 90% probability of success. So that is your 80% probability. That's your basic high probability trade. Now, a low probability trade, which is probably something you haven't seen before, is got a 50% probability of success. Now, before you throw this one out the window and say, well, that's no good, I'll talk to you about that in just a minute here. And then another one which you might not have heard of is a one expected move with Iron Condor. This is a bit of a hybrid. So let me go through the 3 different Iron Condors, and you can make up your own mind here in a minute as to which one seems to make sense to you. So the high probability, here we are. Again, these are like 10 delta short strikes. Try to keep the spread widths, relatively narrow as much as we can. A lot of people start out this way, and I was certainly one of them. I was a big proponent way back when markets were a little bit less volatile, of setting up these long distance, way out of the money, high probability Iron Condors. And I used to even leg into them. So I would look for a big move up into exhaustion and wait for the pullback. So I'd set up the call spreads up here, wait for the pullback, set up the put spreads down here, and widen out that Iron Condor, and then look for ways to tear it down. Pretty expensive though, and pretty heavy duty in terms of commission costs for that. But there it is. These days it's a little bit different. So a lot of folks that do these types of Iron Condors intraday like to leg in and out of them. They like to leg in and out of these types of trades. So I'm not going to say one way or the other as to whether that's good or bad. What I want to do is just highlight for you. These are not what I would do. In fact, I don't do any Iron Condors like this anymore, because all it takes is one trade where you settle out of the money like this, or in the money, I guess would be a more correct way to say it, and then you're toast. Right? So you can get one loser will eat up the profits from several winners, which is the definition of eating like a bird and crapping like an elephant. Here's the low probability Iron Condor. Now, this is a 50-50 trade, a 50% probability of success, which you'll see is the amount of risk you're taking is the same as the amount of reward. So 1-to-1 risk reward trade, 50% probability of success to begin with. Now, the key towards this, though, so you might say, well, that's no good. The other one's much better because it's much wider. Yeah, but notice how much more credit is available to this. How much do you need for the trade? In my case, I'm looking for $100 a day. It's much easier to make $100 a day being in this trade for a short period of time versus a high probability Condor being in all day long in order to earn $100. The other thing too is that this is sort of a set it and forget it trade. This is what I consider to be the Viking funeral. You guys know what a Viking funeral is. put the person on the boat, set it on fire, push it off the shore, and then it eventually will, burn into the fjord. That's the attitude I want to set when I take on one of these trades, is that I'm not going to sit there and roll this thing out. I'm not going to defend it. I'm just going to let it go, because I've set my risk on this trade from day one. I've made sure that this R value here is consistent with something that I can handle. It stays below my risk radar. And I can simply, if that's what I end up losing, then I'm okay with that, right? Never up, never in. And usually what we're looking for is some kind of, we're not looking for the full profit on here. We're looking for our fair share, whatever that is. That's a low probability condor. Now, the thing here that you have to understand is that the options are closer to the money than the high probability trade. This means that those options will burn faster. They will burn those ice cubes are closer to the fire. Let's put it that way. Right? So a low probability trade, don't underestimate the power of this one. This is where I trade most of my longer term iron condors like this right now, because I can get in, get my fair share, and get out and reduce the time risk. And that to me is the most important thing. That overnight time risk is everything in today's market. Now, let me go to the third one here, which is the one standard deviation iron condor. This is one with a 68.2% probability of success. This is a compromise in every way. Now, how do you identify where to put the strikes on something like this? Well, let's cover that. So we're going to put these at one standard deviation, plus minus, and you'll see this. Maybe you've been looking at this for years over here in the option chain. So there's the volatility, and here's the expected move. And so it tells you right there what your expected move is, and an expected move, one standard deviation, gives you a probability of 68.2%, roughly there. We can also approximate. Sometimes it's a little bit difficult to sit there and do the math and say, okay, current price plus minus this. You can just cheat and look at the 20 delta is really, really close. The 20 delta is pretty much what you're looking for. So it's not a 10 delta like the high probability. It's not a 30 delta, which is what the low probability is. It's a 20 delta. So it's a little bit further out. It's a hybrid, right? It's just a hybrid iron condor. So this is a combination of a high and a low, and works pretty well for what we want to do. This is mostly what we do in our trading room, is the one standard deviation iron condor. So which one is best? It's kind of like saying which religion is best, right? High probability condors. These are slow moving. Time value takes forever to burn off of these because they're way out of the money. They don't pay very much, but they're best for those that can't actively manage. So if you're trying to do these things in a full-time job and you can't manage the trade, you can't monitor it, you just have to sort of set it and forget it, maybe this is your best alternative, although I would never do these again. I won't do these in today's market. The low probability condors has the tightest range, but the fastest to profit, because the short options are closer to the money. These are best for active traders that want to earn their fair share quicker and be done with it and get on and move on with their lives, right? And then the expected move condor is a good compromise. It takes about, if I'm trading one contract of the SPX and getting a credit somewhere between like $1.60 and $1.80, it takes me about 3 hours to earn the full $100. Some days I have the patience for it, other days I do not. So I can actively manage risk if I step in front of a trend day, but I'm going to have to actively exit that trade. I can't just sit there and let it expire, because it's going to eat up 3 days worth of profits. Let's talk about exits and management for a second. Anybody can enter one of these trades, but the skill comes in knowing when to enter and how to exit. To me, a great offense is your best defense. Avoid the trend day. The trend day is one of those freight train days where it just takes off and it just keeps on going. And it will run over everything in your path. So unless you're patient enough to wait for the trend to exhaust itself, and maybe you'll get a 2-hour sideways coil in there that you can trade against. If you're patient, maybe you can do that. Otherwise, I typically just avoid trend days. I don't adjust the iron condors. I don't adjust. Now, I do with the next trade I'm going to talk about, but I don't adjust the iron condors because you can just get too whipsawed by these things. So I try to keep it simple. I like to keep it. I'm a simple guy. It adds more risk. And don't forget, if you got to take a loss on these, just take it, suck it up, take the loss, just move on. Try not to make the loss too big. There's 2 more days remaining to trade every week. You'll have your shots at this. You're not going to win every single one. It's okay. That is the 0 DTE iron condor. Okay. It's a very good weapon for that. But the one that I've been using more has been the calendar spread. These are faster to profit than iron condors, but it places a greater burden on you, the trader, to appropriately pre-qualify these. You have to use a little bit more of your noggin to be successful with these. So what is a calendar? A calendar is a time spread. You probably can't see this very well down here, but basically what you're doing is on the same strike, you're selling the 0 DTE, selling today's option, and then what you're going to do is you're going to buy another option a few days out. And the one that's a few days out is going to be significantly more expensive than the one that you sell. So the combination of these two is going to be a debit. It's going to be, it's positive. It's not bringing in a credit. So you're like, whoa, that sucks. I need to have a credit to think that I'm doing income trading. Nope. You can buy or sell. It doesn't matter what you do. What you're looking for is the differential between what you sell and then what you buy it back for, or what you buy and then what you sell it for later. Doesn't make any difference at all. Don't fall for the illusion of that. So calendar spread is definitely an income trade just because it's a debit. What's the edge to the trade? This is the really cool part here. And I want you guys to really understand this, okay? Because it's simple and it never goes away. What I want you guys to do is I want you to trade strategies. I want you to use analysis techniques, everything else that does not go away. I can't tell you how much the market's changed in the last 15 years. The stuff that was working 15 years ago, and by God, some people are still selling it, programs as if it's still the same market, which blows my mind, right? Markets change their stripes all the time. The character changes all the time. This is why studies go in and out of vogue. What was working last year doesn't work anymore. What I want you to focus on is that things that never will go away, just like the sun is going to come up tomorrow morning. And this is one of them. The red line is today's 0 DTE. That option will start out at a certain level of value and the extrinsic value will go down to 0 by the closing bell. It will happen, sure as the sun comes up tomorrow. What will also happen is the back option that you buy, which has got some, we'll just call it T2 here. It's got more time value to it. It will decay more slowly than today's option. And what we're selling is the differential. The differential between these two, that's where the profit comes in. The differential between these two options is the front option expires like crazy or just decays like crazy today into expiration. And the back option retains most of its value through today's trading. This is a fundamental edge. Will never disappear. But we have to teach you to take advantage and to take care of this edge because it's not as easy as it sounds. What are the risks? Trend days are a problem, just like with the iron condor, a trend day is a problem. We step in front of a freight train day of a trend, no trade. I don't care how good you are. And don't try to make these crazy little, well, if I just buy back the short option and let the long option run. No, don't do that. Don't do that kind of stuff. Don't fall for those rookie mistakes. So trend days are a real problem, as is shrinkage. Shrinkage is a bad thing, right? Shrinkage, and you guys are not used to this because you're used to an expiration graph that stays steady. as is any vertical spread, as is any butterfly, as is any iron condor. They will not budge. That expiration graph is built out of granite. It will not move. But that's the problem here with the time spread. They do move. So if the vac vol collapses, what will happen is you get shrinkage. What happens is the overall P&L graph of the expiration will actually drop, and it will force everything down. And this is the worst case scenario for this. So you have to do everything in your power to avoid that, to understand why it would happen and not let that happen to you. Now, I can't adjust for trends. And this is one of my favorite things about the calendar spread. Now, not that you can't do this with an iron condor, you could do this with an iron condor, but I just like these better for it. What I can do is, this is actually a double calendar. And you can't really see this all that well, but this is the first calendar like this, like that. And then if you add the second calendar like this, like that, you have a double calendar. So it ends up being this sort of circus tent looking affair. Now, what happens is when you double the calendar, all is not well, right? It's not perfect utopia, because what happens is all of a sudden, now you've got two options which are out of the money again. And if they're out of the money, that means that they're going to decay more slowly. So if I have to, I will double a calendar spread. I'll turn a single into a double to give myself more room. But it's going to slow down the trade. Everything slows down. It makes me have to spend another few hours to manage this thing, which I don't like. I like to get on with my life. I like to trade in the morning, get things done, and then be creative in the afternoon. So adding double the capital, double the risk, slowing things down. So it's not perfect, but it is a very viable strategy. Let's talk about exits and management. So what I do is I actually run a spreadsheet here. I've got it all plugged in. I don't have to think. I'm just a mechanical, I'm just an obedient idiot, right? That's all I'm going to do is I understand my strategy. And when the numbers get hit, I just do what I'm told to do. I want to get my fair share and get out. Now I can use my noggin. Like if this trade is showing a profit in a single calendar, and if it's not at my profit target, however, if it is showing a profit and if I can still get out before I adjust, then I'll do that. There's no reason to adjust and double the capital and slow everything down just because some spreadsheet tells me to. I can use my mind in there. I can be discretionary. It's very common for this trade. It's very common for the calendar spread to see $100 in 30 minutes. This happens all the time. If we nail the entry, and if we don't have any other strange things happening with volatility, $100 in 30 minutes is very common. Let's compare and contrast the iron condors and the calendars. Iron condors are easier to trade. They're easier to understand. It's more hands-off. However, they really work better when we have a little bit more volatility, right? This is a short Vega trade. It helps when implied volatility is slightly higher and we expect it to come in. So once we start getting really low VIX values and we have an expected move down to, plus minus 15 points a day, like, that's a really narrow trade. And it's not very fun to trade these. So calendars and time spreads are better in low volatility environments. It's much more rigid qualification. It puts much more premium on you understanding what you're doing. But it's a much more responsive trade. And it's my preference in today's market to trade these unless we have the volatility to support an iron condor. Okay, so those are the calendar spreads. I'd be remiss if I didn't talk about some element of charting here. Okay, what technical charting tools do we need to help us with zero DTE trades? Well, it ain't no study, right? We cannot use lagging studies to figure this out. So throw those away. If somebody says, well, what you have to use is the the DMI on here with a plus minus, DI plus, DI minus, and that will be, no, no, no. These are all lagging studies. This is not going to help you. So you have to be able to use price to understand this. Okay, so get it on. So first of all, the first thing we need to understand is price gaps. Price gaps are where the S&P will trade through the futures overnight and create, it jumps over to the pack rim, and then the Europeans pick up on it. And next thing you know, we've got a gap of 30 or 40 points in the morning. Okay. Is that a freight train day? Is that a trend day? Or is that just going to get filled later on like yesterday did? Right. So the S&P will gap up and down. What we have to see is whether or not the price has any interest in filling that gap. Because if it does, then we need to know that, because it's going to turn into a trend day to the opposite side, right? It's going to be very difficult to trade like that. Now, here's what we can use to sort of set up the battleground is the opening range, which prints in the first 30 minutes of the S&Ps. And it gives me an idea of what the market thinks about the value of the day. So that's the opening range, and then I carry it forward through the rest of the day. Actually, I have studies that do this automatically for me. And I typically will just track the S&P through tick charts, which I find show me a better view of what the price is doing than just a standard time-based chart. So I'll carry the opening range, and as long as the price is staying within that opening range and behaving itself, then chances are very good that I'll be able to set up a 0 DTE calendar or iron condor and have it be successful, as long as that opening range is not incredibly wide. So this is my number one tool to be able to use to understand the frame of reference for the trade. But keep it simple. Use the KISS principle. You can't predict the future. Do the best job you can to avoid being trucked by a trend day. They're going to happen. You're going to get run over. Just do the best job you can to qualify them when you can. Give yourself a break. Nobody knows the future, right? But don't wait until everything feels good. If you wait for everything to feel good, that means that you're about to get run over, because that range contraction is going to turn into range expansion all over you, right? You're going to get run over. So you quite often have to enter these trades when it feels the least likely to go sideways. But if I do see that opening range setting up and it looks to be behaving itself, I'll jump on it. So that's charting for these trades. Now, a couple of examples, and I'll wrap up here today. Looks like we're about on time. These two trades were yesterday using the 17 June options. This one was crazy. I have never seen one go quite this fast. So I was in for a $30 debit, and 7 minutes later was out for $31.30. So that's $125 in 7 minutes, 27.7% return on risk. So this is a larger trade. This is an SPX. You could place these on the spiders as well for 1/10 the cost. So that would be approximately a $300 trade instead of a $3,005 trade if you just use the spiders. I did an iron condor at the same time. Now, you might recognize this as an expected move iron condor, 68.2% probability trade. I got initially a credit of $170, and then it just stopped moving, right? I was not willing. I'd already got the profit on the calendar spread. I was not willing to sit there for another 2 hours to get the remaining $50 to get $100 on the iron condor. So sometimes I lose patience with the iron condors. Once you trade the calendar spreads, you get spoiled. Hold time in this case was 50 or 78 minutes to get $50. Okay, so those were yesterday. Those are very common. We do these things constantly. We do these things 3 times a week in our trading room. So let's put it all together. Let's summarize, and we'll get you on your way here to Andrew. There's one very narrow path to success. I've only seen one path to success, guys, and it involves around you getting good at one thing. Make the shift to an income focus, get rid of the old paradigm, and get good at one thing. So forget about growing your pile, because there's going to be no interest. So unless you're able to create passive income from that pile, focus on income instead, especially of a small account. Use options, don't use stocks. You're not going to be able to create income based on stocks. Dividends are worthless these days unless you get a crap stock. So use options. Spend the time. Focus on something attainable, reasonable. $100 a day is very reasonable. It's not that hard to attain. And even if you have a smaller account, maybe focus on $10 a day. Whatever it is for you, just get used to cranking the wheel. Get good at one thing. Repetition is the mother of skill. 0-day options. They have a 6.5-hour lifespan. They display very specific characteristics that if you understand them, you can use them to build edge for your trading strategy. Learn about iron condors. Pick an iron condor that fits you, your lifestyle, your level of knowledge, your risk parameters, right? You can trade these on the SPX, or you can trade smaller ones on the spiders for much less capital for this. Learn calendar spreads. This is one step up the knowledge curve. Calendar spreads will teach you how to think in multiple dimensions of price, time, and volatility. For most other trading strategies, all you have to worry about is price. But here, you got to think in 3 dimensions constantly through this. It'll make you much better at what you do. Trade small to begin with, guys. Use the spiders, or use single contracts on the spiders until you know what you're doing. I will always say repetition is the mother of skill. Just keep doing it and learning from every cycle that you have. So I'll answer some of these questions when we get to the end here, which we're just about at. So let me summarize here. It's my belief that everybody needs to shift to an income-based focus, ditch the old paradigm that does not work. So you might be wondering how to do this. You might not know, this might all sound good to you, but you need some kind of direction. So you can certainly start by joining us in our community. We're a community of traders that seek high probability, low risk trades in the options and futures markets, seeking to earn $100 a day. So we provide the structure and guidance to show how to quickly come up to speed on the 0 DTE strategies. We have several customers that are knocking it out of the park in these things. Plus all of the other intangibles that are necessary for success. Don't neglect the space between your ears. There's a lot that you have to unlearn to become a successful trader. Goals are for people who care about winning once. Systems are for people who care about winning repeatedly. This is what we focus on. So here's what we do at Ready, Set, Trade. We have a live daily trading room. We have 9 sessions a week going on. We have 5 times a week, we have a daily newsletter, including a video, live online community that you can interact with and ask questions, live trade notifications and adjustments when we place them. We have the $100 a day course that show you how to build the system to make $100 a day. Plus, we have other courses depending on the strategy briefs, research notes. Basically, how do you get edge trading this market? And we have, just some very quality materials here. We believe in doing things the right way. Okay, so if you want to join us today, we're having a special. If you go to readyset.trade/0, it's $79 a month, but if you use the discount code, the coupon code 0 at checkout, you can get 20% off. So this is a hell of a lot of value for a very small monthly fee that we have here through our elite membership. So readyset.trade/0. What's that link again? There you go. Don't let your discount expire, because it expires in, I don't know, something like 12 hours from now. So I hope to see you in our room. And at this point, I will take questions for about the next minute before Dave sets up for Andrew. Or Felix in this case. It's Felix, right? Okay, what is my win rate using DTE? I have not lost a calendar yet in the room. And we're running a win rate overall of 78% with a 2.8% or 2.8 profit factor, which is ridiculous. What is the difference in risk between SPX versus Spider? Any risk of assignment? No, there's no risk of assignment intraday. There's no risk of assignment intraday. Typically, the assignment on the American Settled Spider would be overnight. You just have to worry about days like tomorrow, which are ex-dividend, right? So you just, you don't hold things overnight, so you don't worry about dividends. and assignments. Let's see. Ready set dot trade slash 0. Let's see. There any other questions in there? What's the difference? What's the worst case scenario for the calendar spread? Worst case scenario for the calendar spread is a 15%. So if I absolutely, like, if we step in front of a May 6, 2010 move, like from the, what do they call that? The flash crash 10 years ago. If we step in front of something like that where I just can't adjust it fast enough, then I will bug out at 15%. That has never happened to me though. But there it is. I know what the exit's going to be if it ever does happen to me. Okay, let's see. Can these techniques work in the crypto market as well too? On paper, yes. They're more difficult to do because you don't have that many. You certainly don't have 3 times a week. You don't have 0 DTE expirations. So that's Linwood. Do you still have to close at the end of day? Yes. Yes, you do. Close everything. Hit your profit target and get out. Don't leave it up to the broker to close the position for you. Always close these things, right? Always close these trades. Okay, I think we are through. Thanks very much. I look forward to seeing you guys. If you don't join us, meet us in our Discord. David, thank you very much for inviting us, and I hope to see you guys later on.